When a business expands its physical footprint across a map, it faces an immediate structural threat. The further its operations stretch from headquarters, the faster its central financial oversight completely deteriorates. A branch is not a subsidiary company with its own autonomous legal structure. It is an extension of the exact same corporate entity, just operating in a different postal code. You might see this storefront operating hundreds of kilometers away from the central hub, yet it presents the exact same branding and pricing to the consumer walking off the street. But how does its distant headquarters verify that this specific location is actually profitable? How do they prevent localized inventory theft without incurring the massive overhead of stationing a professional accountant at every single storefront? To survive this geographical fracture, an enterprise has to engineer a specialized accounting architecture. A system designed specifically to bridge the gap between remote physical operations and central financial control. This structural solution is known as branch accounting. Its primary objective is segmentation. It isolates the revenue and costs of individual geographical locations to calculate exact regional profitability, revealing which specific outlets are self-sustaining and which are draining capital. Its secondary objective is security. It enforces rigid internal controls to safeguard remote physical inventory and cash collections from mismanagement and pilferage. To see how this system captures data, we are going to construct the financial architecture of a standard retail model, known as a dependent branch, building it upward from fundamental first principles. This is the mechanism that translates the chaos of remote decentralized sales into structured, auditable data back at the central hub. By definition, a dependent branch operates with zero accounting autonomy. The staff on location maintain no double-entry ledgers. They are entirely reliant on a centralized supply chain. Every unit of inventory must be shipped directly from the head office, and local branch managers are strictly prohibited from procuring goods from third-party suppliers. The financial tether is equally rigid. All daily cash collections from sales must be deposited directly into a bank account controlled entirely by the head office. To handle minor daily operations like cleaning supplies or local transport, the head office issues a strict petty cash fund through an impressed system. Branch managers are explicitly blocked from spending their own localized sales revenue on local expenses. The head office absorbs all the financial risk and manages all the bookkeeping. The remote location functions solely as a streamlined conduit for moving inventory and capturing sales. Because the branch is structurally blind to its own finances, the head office must deploy a bookkeeping methodology that acts as a financial proxy for that remote location. The most basic architectural framework deployed by the head office to track these units is the debtors method, also known as the synthetic approach. This single ledger treats the entire remote branch ecosystem as if it were one giant debtor to the company. Everything the head office sends to the branch is recorded here on the left, the debit side. This includes opening asset balances, the cost of goods shipped, and the cash wired over for expenses. Everything the head office receives back is recorded as credits on the right. This captures the daily cash remittances, any returned inventory, and the value of closing assets, outputting a final balancing line at the bottom representing net profit or loss. The arithmetic works, but operationally, this method has a fatal flaw. It functions as a synthetic black box. If the final profit figure comes back suspiciously low, this single consolidated account provides zero forensic detail. It cannot tell the head office whether that loss was caused by a legitimate drop in consumer demand or by abnormal inventory shrinkage due to employee theft. The debtors method is administratively cheap to run, but it completely fails to protect the inventory. To secure its remote assets, the head office requires a higher resolution analytical framework. That structural upgrade is the stock and debtors method, widely known as the analytical approach. Here, that opaque black box is shattered and rebuilt into a web of granular ledgers: the branch stock account, the branch debtors account, and the branch adjustment account. If we isolate the branch stock account, its primary function becomes clear. It is designed specifically to track physical inventory units moving in and out, flagging any mathematical shortages. To enforce this tracking, the head office deploys a specific accounting mechanism called invoice pricing, or loading. When goods leave the central warehouse, they are intentionally billed to the branch at an inflated price, not at actual cost. A base cost of 100,000 rupees combines with a discrete markup of 25,000 rupees to form a total invoice price of 125,000 rupees. The branch staff only ever sees this inflated top-line figure, keeping the true margins entirely hidden. By forcing the branch stock account to balance opening stock and goods received against sales and closing stock, all at this inflated retail price, any missing inventory creates an immediate, glaring deficit in the ledger. Invoice pricing forces the branch manager to be strictly accountable for the full retail value of the goods, surgically isolating any pilferage. But this internal security measure creates an immediate accounting paradox. Inflating inventory values explicitly violates the conservative principle of accounting, which dictates that stock must always be valued at cost. A company cannot legally record an unrealized profit on its consolidated balance sheet just because it moved a box from its central warehouse to a branch warehouse. To resolve this, a strict year-end reconciliation is mandatory. The head office has to mathematically strip that inflated loading markup out of the value of any unsold closing stock remaining at the branch. The profit markup is extracted from the stock value and physically deposited into the branch adjustment account. This specific extraction is recorded as a stock reserve. It nets against the inflated figures to output the final, historically accurate gross profit. Stock reserves act as the vital mathematical bridge. They allow an enterprise to leverage inflated prices to secure its inventory internally, while stripping those inflations out to report strict, factual costs to the public. Beyond internal management, branch accounting functions as a rigorous statutory mandate under Indian corporate law. Under the GST regime, branches located in different states are legally classified as distinct persons. This means that an interstate stock transfer from a head office in Karnataka to a branch in Maharashtra is legally treated as a taxable supply. It triggers strict invoicing requirements and immediate tax liabilities, even though the goods never left the company. This legal reality makes the year-end audit incredibly demanding. Auditors must meticulously reconcile goods in transit, accounting for inventory that left the head office ledger in March but physically hasn't arrived at the branch by the March 31st cutoff. The analytical rigor built into the branch ledgers provides the exact granular data required to reconcile input tax credits and satisfy statutory auditors probing for tax leakage. Scaling a physical business footprint across vast geographies carries an inherent threat. Physical distance actively erodes centralized control and exposes capital to risk. Deploying dependent branches, units stripped of their accounting autonomy, allows an enterprise to achieve massive physical scale without the burden of administrative bloat at every location. Combining the analytical tracking of the stock and debtors method with the internal security of invoice pricing, the head office systematically eliminates inventory shrinkage. Ultimately, branch accounting provides management with the exact data needed to segment and analyze geographic profitability, while keeping all financial risk locked safely at the center. It is the architectural blueprint that translates the chaotic reality of physical decentralization into rigorous, unified financial dominance.